Hello, my name is Court Brady, and my presentation is on residential real estate. Residential real estate includes all of the following: homes, apartments, trailers, condos, really anywhere where a person or a family would live for an extended period of time. The current situation in the United States is that since the crash in 2008, real estate prices have continued to rise. Some specialists speculate that there's another bubble being formed. However, this is just speculation. The nice thing about residential real estate is that you can make money during the good times and the bad times. And the rest of this presentation will show you how. Generally, there are two sources of capital that are gained from residential real estate. The first is capital from cash flow. The second is capital from appreciation. In the subsequent slides, I'll explain what those are. Both of them can be viable, and there's often income realized from both cash flow and appreciation. Capital from cash flow. To think of it the easiest way, you can think of a rental property as being run like a business. In that, in your business, you want your revenues to be greater than your expenditures, because that is what your net income ends up being. So rent revenue would be things such as rental income, parking permits, and late fees. Expenses would generally include such things as property tax, maintenance, and advertising, etc. As you can see at the bottom, the higher your revenues are, the lower your expenditures, the greater your income is going to be. The next is capital from appreciation. This one is also run like a business. However, the difference is that your property is actually your product instead of the rents being received. What that means is you want to buy the property low and sell high. The term house flipping deals strictly with appreciation income, in that there are no renters, therefore no rental income. There are a few advantages of holding properties for longer than 12 months that I'll briefly go over. The first is that if a property is held for more than 12 months, then when it is sold, the income from the sale is tax-free if the money is reinvested into real estate within the same year. That's called a 1031 exchange. To put it in simple terms, if you sell a house and you reinvest that money that you made selling the house in another property within that time period, then you don't have to pay taxes on it. It's deferred. The next advantage of holding a house for at least 12 months is that it allows you to take depreciation expense into account when paying your taxes. All this means is that you can show that your expenses are higher because your property is virtually depreciating in price and cost, which will decrease your expenses and then increase your cash flow. In overview, residential real estate is a smart path for those just wanting to dip their toes into real estate, because the barriers of entry, which are mainly costs, are generally 10 to 20% of the property, and they're considerably low compared to investing in commercial real estate. Choose whether you'd like a steady stream of passive income, or if you'd like a large amount of money all at once when you sell. This will help you know which kind of property you want to purchase. The nice part is you don't have to pick one or the other. You don't have to just pick a rental property where you receive cash flow, or to buy a house and flip it, appreciation income. You can buy a fixer-upper, fix it up, rent it out for an extended time, and then, when the market is right, you can sell to take advantage of all the types of income. Thanks for watching.